I put a shout out on my Instagram last week to ask people what they struggled with most in CeMAP 1. And a lot of people fed back to say gilts, which I've done before. So definitely go and check out the gilts video, but also collective investments. So I thought in this video, I would dig a little bit deeper with the collective investment stuff, because a lot of people see things like unit trusts, open-ended investment companies, investment trusts, and don't really understand the difference, which is completely understandable and what I'm going to help with. The first thing that we need to talk about is what is a collective investment. And we're going to start really simple. So a collective investment is just a way for a lot of people to put their money in one pot together or pool it together so it can be invested as a big pot of money. So instead of trying to pick the individual investments yourself, you might not want to do that. You might want to hand that responsibility over to somebody else and also benefit from the fact that they already have loads of money so they can invest in bigger assets. I think of this like a group holiday. So everybody has to chip in a little bit of money, but it is usually one person's responsibility to do the organizing, to make sure you've got your baggage allowance, your flights, all of that stuff is down to one person. That's kind of like a collective investment. So you have a fund manager with these, and that is the person that arranges the holiday. They decide where to invest the money, and you get to enjoy the returns or the holiday minus a little bit of cash that you offset for things like admin costs. There are two main reasons that we use collective investments, and the main one and the big one for your exam is something called diversification. So this is the concept of spreading your risk. So if you have £100, that's not going to get you very far in investment terms. You might be able to buy one share in a small business. If that small business collapses, you're not going to get your money back. But if you put your £1,000 or £100 into a pot with everybody else's £100 or £1,000, all of a sudden you can split what you're investing in because you've got more money to play around with. That's the benefit of a collective investment. That's what diversification is. So you are diversifying your assets to minimize risk. There is a really popular story of somebody, I can't remember their name, but they were named on the Forbes, is it the 100 richest people list, for about a decade. So every year for around 10 years, they were one of the richest people in America. The problem was this particular gentleman invested all of his money in his own company. He did not diversify whatsoever. His company got into financial difficulty. He very quickly dropped off that Forbes 100 list because he had not diversified his assets. So that's why we like a collective investment, because it lets you diversify. The second benefit is professional management. So you are paying somebody else to do all of the hard work for you. And that's basically what the exam wants you to know as a fundamental baseline, that there's two benefits: diversification and having access to a professional fund manager. They reduce your risk and they give you expert advice. So that's collective investments. We will move on next to something called a unit trust. So a unit trust is something called an open-ended fund. And this means that it either expands or shrinks depending on how many investors are in it. So the way that it works is if you wanted to invest in a unit trust, you can buy in, new units are created, but when you decide to sell up, those units are just cancelled. That's why it's called open-ended. It can grow and shrink as needed. Now, the price that you pay for each unit is based on the value of the fund's assets. So you generally see two prices quoted, or two main prices. One is called the bid price, and this is what you get if you sell it. And then you've got your offer price, and that is what you pay if you buy it or to buy in. So the difference between the bid price and the offer price is something called the bid-offer spread, and it's basically the cost of doing business. That's what that is. And remember, with unit trusts, there are two key roles within this business. You have the trustees. It's their responsibility to look after whatever is in the trust. And you have the fund manager, whose job it is to make you money. So they're going to run the investment. They are trying to grow your wealth. That's the structure with unit trusts. One thing that really helps me understand this is I think of storage hunters. I don't know if you've ever seen it. If you haven't, The basic premise is people go and bid on storage containers. They have no idea what's in them. So they pop the shutters on a storage container, they show you the contents, but you cannot step inside, and you bid on what you think is in there. Most of the time, for entertainment purposes, the stuff is covered with a blanket. Or it might just be a cash machine in a storage unit. Is there cash in it? Is there not? That's the whole high risk, high reward kind of a vibe. That is a unit, as in a storage unit. So if we link that back to financial services, when you think about a unit, you are buying a bunch of different things all in one place. So if you invest in a unit, you might be buying shares across 7 different industries. That's great because you've diversified your assets. It's also pretty risky because you're investing in quite a few things at once. That's how I like to remember units. And then trusts. I am going to do a separate video on trusts just because they're a little bit more complex. But the basic premise of a trust is it is where you take your money and you put it somewhere where it no longer belongs to you. So from an investment trust perspective, from a unit trust perspective, you take your money, you put it in a pot, you give that pot to the investment manager. It is their job to go and invest that money. The trustees are going to make sure that money is spent wisely and the investment manager is doing right by you. But that's the basic premise. So investing in units, putting your money into trust, unit trust. Okay, let's move on to open-ended investment companies, or OEICs. These work very similar as unit trusts, but they're set up as companies rather than trusts. So a unit trust is a trust. And you have trustees, you have beneficiaries, all of that stuff I'm going to cover in a separate video because it's too heavy for this one. But an open-ended investment company is not a trust. They are companies. And instead of buying units, you are ultimately going to buy shares in the company. So the key difference for your exam is that open-ended investment companies have one single price rather than these bid offer prices. And they are simpler, more modern, and more popular in the UK as a general. And finally, we have investment trusts. And the one thing, if you are making notes from this video, that I want you to write down is that an investment trust is not a trust. So even though it has trust in the word, we are not going to use the basic principles of a trust for this. It is a limited company whose job it is to buy and sell shares of other companies. So they are what's called closed-ended. So this means that they can't make more shares when they're really popular or cancel down shares when they're less popular. There is a fixed number of shares when it's launched, and those shares are then bought and sold on the stock exchange, just like any other company shares. Now, because they're traded on the stock market, their share price can go up or down quite spectacularly, just like any other type of business. And it's called trading at a premium or at a discount to the NAV, which is the net asset value. You actually don't need that for your CeMAP exam, so don't worry too much about that. But what we do need to be aware of is something called gearing. Now, gearing is where an investment trust borrows money from somewhere to invest more. So they are going to borrow money, possibly from a bank, and they are going to invest that money. It is almost like the equivalent of you taking out a bank loan to bet on a horse on the Grand National. Very risky, but allowed in financial services. If an investment trust believes that the markets are going to rise, they will gear or they will borrow money to put into that particular investment. That comes up very often for people in CeMAP 1, so make sure that you flag that. So, quick recap then for exam reminders for collective investments. We have unit trusts and open-ended investment companies. They are open-ended. We have investment trusts that are not trusts. They're just limited companies, and they are what's called closed-ended. Unit trusts have this concept of a bid offer pricing, whereas open-ended investment companies have single pricing, and investment trusts can use something called gearing if they think the markets are going to rise. Now, hopefully this has been a really helpful recap for your CeMAP 1 studies. Make sure that you also go through the other material, whether you're using the textbook or something like my e-learning platform. Remember that you can try 12 hours worth of e-learning material completely for free, and I will link it in the description. You can also sign up to my 60 days to CeMAP strategy, which is completely free. It's 60 days worth of emails that are going to help you get over the line with your CeMAP exams. And I'll catch you for the next one.